We're heading into an eventful week, and we can already say that it may be an emotionally challenging one. Three leading central banks, the Federal Reserve, the Bank of Japan and the Bank of England, will announce their latest decisions regarding monetary policies. For the Fed, we see little suspense after heavy disappointment in May's jobs reports. We remind you that the US added only 38,000 non-farm jobs during last month. This was far too weak compared to the 160,000 expected. Although the FOMC chair Janet Yellen said that single months data is not enough to drive conclusions regarding the health of the US economy, she had to admit there was a big miss on her speech on Monday. The expectations for June interest rate hike tumbled to 4% from 20% a week ago, while the probability of the July rate hike nearly halved to 27%. We believe that the Fed will not be in a position to act any time before the September meeting, although we do expect to see some hawkish Fed members defending the idea that 2 rate hikes is still appropriate for this year. The majority of voters will certainly prefer to play it safer. This means that the US dollar should remain relatively cheap for a longer period of time. And although some investors may think that the economic conditions in the US are not encouraging enough, the stock markets could well take advantage of the potential dovish shift in the Fed's monetary stance to extend their gains. The global stock markets are already trading nearly at 2016 highs at this first part of the week. The cheap liquidity is expected to lend some support to the equity markets globally. Therefore, the favourable liquidity conditions could be an opportune time for investors looking to jump on the back of a bull. In the FX market, traders trimmed their long dollar positions throughout the week. Therefore, the Fed could be a buy the rumour and sell the fact, in which case we could expect dovish Fed to trigger relief in the US dollar, along with the US stocks. But the upside in the US dollar is expected to remain limited should the Fed sound dovish, as it is expected to. Of course, if Janet Yellen insists on her optimistic take regarding the US economy, then we wouldn't be surprised to see the US dollar rally against the majors, and wouldn't even be surprised to see a disproportional improvement in the Fed expectations. This being said, the macro fundamentals have not changed. So short-term swings in market mood should carefully be filtered. Another important event is the Bank of Japan's meeting. The Governor's Kuroda's words revive speculation of additional monetary stimulus at next week's Bank of Japan meeting. Kuroda said that the Bank of Japan doesn't hold a big stake in the ETFs, which has been unsurprisingly interpreted as if the Bank of Japan was preparing to buy more ETFs in order to boost growth and reach its 2% inflation target. The Japanese yen has been the unique currency to appreciate against the US dollar in Asia on Friday. Despite the dovish Bank of Japan speculations, the yen has failed to gather enough of momentum on the short side. The US dollar hit 106.25 on Thursday, and the rising dovish BoJ expectations could probably suggest that we could be approaching the range bottom towards the 105.56 on May the 3rd. Because it's worth keeping in mind that the yen has been under an unnatural, therefore probably unsustainable positive pressure over the past couple of weeks, we believe that the combination of an ultra-loose fiscal and monetary policy should reverse the current positive trend in yen sooner rather than later. A dovish Bank of Japan stance will probably suggest that we've hit the bottom this week, and moving forward we could expect a recovery toward the 110 mark. Yet this is all contingent on how much credibility the market will give the Bank of Japan. The risk here is that the markets are sometimes merciless. Therefore, although the Bank of Japan sounds and even acts dovish, the market could bet against the bank. And a potential break below the 105.50, 105 mark could then be expected to be at the beginning of the further slide towards the 100 mark. Last but not least, we'll be watching the Bank of England's latest verdict before the Brexit referendum due on June 23rd. We expect the BoE to maintain the status quo at next week's meeting. The sterling will certainly remain under a decent selling pressure given the Brexit-related volatility. It, however, appears that the impact of the Brexit polls is gradually decreasing, given that the inconsistencies in the latest polls outcome brought the majority of traders to re-question the efficiency of these polls. Indeed, similar polls have failed to predict the outcome of the Scottish referendum in September 2014 and the UK's general election in 2015. This being said, the market remains comfortably short sterling in the run to the referendum. High volatility and choppy market conditions will be in play for those willing to trade the pound. We recommend our traders to place carefully their stop losses and be prepared for a two-side volatility, although the market remains skewed on the downside. Thanks for watching today's Week Ahead. Tune in again next week.